All right, everybody, we're going to get started here. I want to say thank you, everybody, for coming to this seminar on 1031 like-kind exchanges. And we have some good content for you, but most importantly, we're thankful for you to be here. We're thankful for this is really a BIA, Building Industry Association of Lancaster event, and we're glad to partner with them, us being Trout, CPA. Here, this is our main location here, along with Blakinger. So we're thankful to partner with them. And so during the session, if you need a water or a break, feel free just to get up. The bathrooms are around the corner to the right when you go out the back. There's some water in the back over there. There's some coffee in the back left on the other side. And as far as the timeline goes, it's from 3 to 4:30. We're trying to fit the content into that window. And then after that, we have a happy hour in the back there outside of the doors. So look forward to spending time with you all. As far as the content goes, we have Aaron Hollis and I thought we had Seth.
Seth is hiding.
Seth is hiding. This is Aaron. And Seth from Blakinger. And we work hand in hand with them a lot on our clients in this area. And then from the Trout side, we have Randall Weaver and Dustin Peck. And I forget what the order of the Dustin, you're leading off. Yeah. So Dustin Peck will lead us off initially here. Sir. We will have a Q&A at the end.
Yes.
That, right?
Yeah, we will.
You want to go?
We're going to try to leave time within that time before 4:30 to have some Q&A then. All right, so I'm going to start off with some of the basics. Just generally, what is a 1031 exchange? What are the general rules, and how does it work, just from a basic standpoint? So first of all, what is that term, 1031 exchange? So it comes from Section 1031 of the Internal Revenue Code. Under the current regulations, it refers to a exchange of real property that qualifies for tax deferral. And it's also referred to sometimes as a like-kind exchange. You might hear it as referred to as that as well. So, as I said, it's currently only for real property. Unfortunately, when we use the word exchange, unfortunately, that doesn't mean you actually have to swap pieces of real estate with someone else in like a barter transaction. You can sell the real estate to someone and then purchase another piece of real estate from someone else, just like you would normally. You just have to follow these rules to allow it to qualify for the 1031 and tax deferral. All right, so I just wanted to go over a couple of terms that I'll be mentioning as I'm talking, and I'm sure some of the other presenters will as well, just so you know what these terms mean. So first of all, replacement property, that's the term that's the property that is being purchased in the 1031 exchange. And then when we say relinquished property, that's the property that's being sold. And then I'll use the term, I think I typically will use carryover basis, but exchange basis means the same thing. That's the taxpayer's adjusted tax basis in the relinquished property that they're carrying over into the replacement property. So that's their basis after depreciation that they have in their property that they're selling, the relinquished property, and they're carrying that over through the 1031 exchange into the replacement property. And then we have the term excess basis. That's the additional cost basis in the replacement property beyond the exchange basis. So if you're stepping up into a larger property, you're going to put up additional capital, and that's called excess basis. All right, so what kind of property qualifies for a 1031? As I mentioned before, currently it's only real property that qualifies, and it is required to be like-kind property that you're exchanging. Fortunately, the definition for like-kind in the context of real estate is pretty broad. So virtually all real property qualifies as like-kind as long as it meets the the use requirements, which is the second part of this qualification. So that means that it can be, you can go from a farm property to, you know, a house downtown. So it doesn't need to be the same type of real estate property. It can be different types of real estate property that you're exchanging. So what if you have personal property that's being exchanged with the real estate? So let's say you have an office building and it has office furniture in it. Office furniture would be considered personal property. It is not like-kind property. It does not qualify as like-kind property under 1031 rules. Fortunately, there is allowance for incidental personal property. So it's considered incidental if it meets these two standards. One is it typically transferred together with real property in a standard commercial transaction, and two, does it not exceed 15% of the value of the real property. So that's kind of the standard for incidental personal property that might be included in the exchange to prevent it from blowing up your 1031 exchange. So if you meet that standard, if you have that incidental personal property being included in the transaction, it's not going to prevent you from doing this 1031 exchange. All right, so the key qualifier of whether your piece of real estate is going to qualify, like I said, most everything qualifies like kind, but it needs to meet the use qualification. So the two things you can have for use is, one is being used for productive use in a trade or business, or two, it's held for investment. Hopefully the productive use in trade or business is fairly self-explanatory, that it's a property that you're using in business operations. Held for investment, generally that's going to include rental property. So what makes it an investment property is you're renting it out to someone for income purposes. There's some cases where you might be able to argue that property you're not renting out is held for investment, but that's been challenged, and there's different court cases where it's been accepted and some that it hasn't, depending on the facts and circumstances. Generally, it's easier to argue if it's a piece of undeveloped land that you're saying that you're expecting it to increase in value. And usually that's not going to work if you are a land developer or someone who's in that business. Like, for example, where that's not going to work is if it's like you buy a vacation home, you say, I'm expecting this vacation home to increase in value, therefore it's held for investment. No, that's considered personal property, so you can't say that's held for investment. So as I just mentioned, personal use is not a qualified use, so you can't do 1031 exchanges on your personal home or your personal vacation home unless it's being rented out. I think Randall's going to talk later about vacation homes and when that might work. And the other big one is held for sale. So I think this one might apply to some of you in here, being with a BIA. So if you are a home builder or a land developer, the real estate you're holding in inventory for sale is not eligible for a 1031 exchange. That's an inventory asset. You're holding it for sale. That is not it's not considered productive use in a trade or business or held for investment. It's considered held for sale, which is not a qualified use for 1031 exchange. It doesn't mean you can't turn it into one of those uses. Just means like you would have to convert it into either a business asset or an asset held for investment, a rental property, or you could consider you doing a 1031 exchange. All right, so timeline. Fortunately, you do have some time between when you sell the relinquished property And when you have to then close on your replacement property, it doesn't have to be bang, bang. You have about 6 months, 180 days. Now, of course, in real estate, can be a short period of time as well, depending on the circumstances. But even before that 180-day mark, you have to close on the replacement property. You have 45 days to identify those potential replacement properties. And I think I saw in Aaron's presentation, he's going to be talking about some of the specific rules about documenting that requirement to identify this replacement property. So I'm not going to go into detail on that, but those are the 2-day marks that you need to remember: 45 days and 180 days. All right, so this is a basic example just to go through, try to keep it simple and straightforward, just to understand like what it looks like and what the difference is between not doing a 1031 exchange and doing a 1031 exchange. So let's say you have a property, let's say it's commercial property, you purchased it for $500,000, you depreciated it $100,000 to this point, so your tax basis is $400,000. And let's say it's done really well in the market, its current market value is $800K. And you're thinking the market might be changing, you might want to move into a property in a different market somewhere else. So you want to sell this property and buy a new property somewhere else. If you went through the normal process of selling the property and going and buying another property without a 1031 exchange, you'd be looking at a taxable gain of $400,000. So $300,000 of capital gain over your original cost basis plus recapture of the $100,000 of depreciation. So just looking at regular federal income tax, keeping it simple, not talking about the state tax. I'm assuming 25% rate on the depreciation capture and 20% on the capital gains. That's $85K of tax. So you're looking at $715K after tax funds to reinvest, and that's not even considering closing costs as well. So then you're going to reinvest that in the new property, and that's your new basis of $715K. So whereas if you do a 1031 exchange, you let's say go into another property, another commercial property of $800, that's around the same market value, $800,000. You can defer that $400,000 gain and pay no tax on it at this point in time. That way you're able to reinvest the full $800K into that replacement property. And now the key thing to note here is this is tax deferral. This is not on forever tax. So that's why we see here the tax basis in that replacement property is $400K. So this new property you bought is worth $800K, but your basis in it is still your old basis of $400,000. So that's the deferred gain. So it's still sitting there waiting to be taxed later, potentially, but it's deferred. So your basis hasn't gone up by moving into this $800,000 property. It's carried over from the previous property. I'm going to talk a little bit more about depreciation later, but just a quick note. Generally, your depreciation is going to continue then from that carryover basis. That's the difference down there at the bottom of the slide, that it's continuing over the remaining life of that property. Let's say we're going from a 39-year property, commercial property, to another 39-year commercial property. It's just going to continue depreciating as it has been, instead of restarting with a new 39-year tax life. All right, what is boot? So if you have read about 1031 exchanges before or heard about them, you might have heard of this term of boot. So boot is referring to the portion of realized gain you have in a 1031 exchange that does not qualify for tax deferral. So that means it's going to be a taxable gain in the year of sale, and it's going to reduce your deferred gain. So it reduces the gain that you were able to defer, and you're going to pay tax on it now. So what causes boot in a 1031 exchange. So some of the common causes, if you have cash proceeds received, a lot of times that's going to mean you have boot gain because you have not taken all the cash you got from the sale and put it into a new property, new like-kind property. You've taken some of the cash proceeds and kept them, so that's a recognized gain. Sometimes it's not cash. Sometimes it's net reduction in debt. So you essentially had liabilities that were relieved by you selling that property. So you had a mortgage on the property you sold, and on the new property, you might not have a mortgage, and you didn't step up and add more capital in. So you use some of those proceeds from the first property to pay down debt and not reinvest it in the new property. So that's boot coming out as taxable gain. Also, non-like-kind property involved in the transaction. I mentioned before that you can have incidental personal property that's involved in the 1031 transaction. That doesn't mean it's not going to cause boot. So if you have, like let's say that you have, you're going from a $500,000 property to a $500,000 property. The first property, it's all real estate. The second property, you've got $400,000 of value of real estate and $100,000 of, I didn't do the math there, but 15%. Make sure it's got to be on the 15%, but let's say it was $100,000 was the personal property, then that would be boot because you have not reinvested all in real property that's like kind. So the most basic strategy, the boot rules can get complex and there's a lot of strategy around it and things to think through. The most basic strategy I can think of for trying to avoid it is to step up in property value. So if you go from a lower value property into a higher value property, it's going to help avoid some of these issues because you're putting in more capital. One other thing I didn't mention that can cause a lot of times small amounts of boot is if you have all these adjustments in the real estate transaction. So when you sell and buy a property, a lot of times there's adjustments for property taxes, there's utilities, things that are getting paid for within that HUD sheet that are not going into the new property. If you're not stepping up in property value, or if you're not if you're using some of your proceeds from the 1031 from the relinquished property to pay for those, and not putting enough into a new property, that could be boot. So what stepping up the property value does is that way you're putting in additional capital into the transaction that's paying for these items that are not like-kind exchange items, and making sure you're using all of your 1031 proceeds for reinvestment. All right. So depreciation rules. As I mentioned before, the general rule when we have 1031 exchange is sometimes it's called step in the shoes. So the carryover basis you brought over from the last property continues depreciating the way it was. So it continues depreciating over its remaining life, unless now there's an exception if the tax life of the replacement property is longer than the relinquished property, then it just extends out to that new longer life, but it keeps continuing from the beginning point of the relinquished property. So just to keep it simple, it doesn't restart. It continues from where it left off. What that means, though, is that under that general rule, only the excess basis, so only additional capital that you put in would be eligible for cost segregation. So this presentation is not about cost segregation, so I won't go into much detail on this, but generally cost segregation is is when you obtain a study to break down a real property into its different components that are eligible for different tax lives. And the goal generally of a cost segregation study is to accelerate depreciation. It's just another tool for tax deferral, that you're accelerating depreciation, save tax now, defer tax till later. So under the general rule, because you're continuing the depreciation from the carryover basis, you would only really be able to do a cost segregation on the excess basis, which sometimes might not be that significant. So it's usually not worth it to do a cost segregation under that general rule. There is an election you can make to restart depreciation when you're doing a 1031 exchange. And without a cost segregation, generally, in most cases, it's not going to produce tax savings, because you are starting fresh and you're going to depreciate everything over the tax life of the new replacement property out till its full tax life, instead of continuing what you had already started. But in some cases, making this election and then pairing with cost segregation can produce tax savings, immediate tax savings, and accelerated depreciation, because you're then able to use both the carryover basis and the excess basis for cost segregation and accelerate both those items. And there's something to look out for there too. If you know the term bonus depreciation, there's some different rules with that, where you're always able to do bonus depreciation on the excess basis, but the carryover basis, you can only use bonus depreciation if that's what's considered a brand new asset, meaning it's not a building that was previously existing. You would have to be a building you bought directly from the builder or the the builder of the building. So it would have to be a new house or a new building. It couldn't be a building that was owned and rented out or used by the previous owner. So it has to be new in order to use it on the carryover basis. That's for the carryover basis. Of course, you have to make that election first to even consider that. Some other thoughts here on this slide on that front of cost segregations. You have to be careful with cost segregations and 1031s because of what I talked about earlier about the personal property. So when you do a cost segregation, you're identifying every part of this property and breaking it down into its different components. A lot of times that's going to clearly identify items that might be considered personal property. So something to look out for that and then it's clearly, if it's personal property, it's not considered real property for 1031 purposes. That's going to be called boot. Now, under 1031 regulations, there are some types of property that are considered real property for 1031 regulations, but are still eligible for accelerated depreciation under depreciation rules. So what you want to look out for there is if you did a cost segregation on the property you're selling, the relinquished property, and you have property in there that it's considered a real property for 1031 purposes, so it's like kind, but you took accelerated depreciation on it. Maybe it was qualified improvement property or something like that. You took bonus depreciation on it. You might have ordinary recapture. What that means is, even though you're doing a 1031, you can't defer that. So you took accelerated depreciation, you have to pay tax on the portion of that depreciation that is essentially it's accelerated. So you you pay that tax even though the 1031 is valid. You can only defer the capital gain. You can't defer the ordinary gain. I think that's my main thoughts on that. That's my last slide. So
Just quickly add to that. Basically, if you do a cost seg on the property you're selling, you're basically forced to do a cost seg on the replacement property. It kind of,
Right.
I mean, it's very nuanced and you definitely want tax professionals looking at it. But you basically are forced, if you want to do a 1031, to do another cost seg.
yeah, what Randall's talking about is you can avoid that ordinary recapture if you have enough of that same type of property. The term is like 1245 property, or get that same enough value in the relinquished or the replacement property. You can roll that forward and not worried about the ordinary recapture. So that's why you might want to do another cost segregation on the replacement property. So yeah, if you're doing cost segregations and you're thinking about doing 1031s, you definitely want to talk to a tax professional and figure out what the implications of that are going to be.
Excuse me. Real quick, the personal property 15% limit. Can you talk about a farm with a home? How's that handled?
So, yeah.
The home's not separated from the farm, and you want a 1031 the farm. How's that handled?
Yeah. So, are you? What's the use of the farm and the home?
The home. The farmer lives in the home. Okay. He wants to sell the farm.
You're going to have. So the home, the value of the home is not eligible for 1031 exchange if it's personal use.
I didn't know if that was the personal property thing you were talking about or not. The 15% limit?
No, so sorry for any confusion there, but when I talk about personal property, it's, that's good. I'm glad you brought this up. So when I was talking about personal use and personal property, it's two different things. So
okay.
Personal property is non-real property. So that's a car's personal property, whether it's used in a business or whether it's used personally, it's personal property. Equipment, whether it's used in a business or whether it's used personally, it's personal property. So it's kind of like the term in depreciation accounting terms for a non-real property, essentially.
That's the tax code's fault, though.
Yeah.
Right. Yeah. Well, but back to the farm.
Yeah, go ahead.
Then is it looked at for tax-wise as two separate transactions tax-wise?
Yeah.
And the farm portion can be handled as a 1031
Right.
separately from the house?
Right.
Okay,
Correct.
that's all. Thank you.
Yeah, and on that, I would argue, we're getting into a little bit of gray here, but I would argue that you could use 121 for the personal residence. That's the sale of personal residence that
Yep.
excludes certain amount of income, and then the rest you could do a 1031 on. We do those. Where the gray is let's farm, let's not. That's where you talk to the attorneys, you talk to your accountants. Your attorneys are going to help you look at the tax code and say, yeah, I think you can do X, and we can push it this far. And then the accountants on the other side say, but I got to sign this tax return, and we got to be at a level that, we can do that. Related to that, does anybody know the difference between an accountant and an attorney?
Oh, boy.
No guesses? So there's a lot of differences, obviously. One of those differences is the accountants invite you in, give you information, and send you on your way. The attorneys, they have to give you a disclaimer. I'm surprised we don't make them sign a contract or something. To that point, though, it does say, why we put this in here, I don't know, but it does say that, everything is different. Every situation is different. I know 1031, there's a lot of, we were talking about this before we started, there's a lot of online providers who will give you documents very cheap. And that is an option. If it's extremely simple, 1031, they're fine. but there's so many of them that are nuanced. And having advice is helpful. So you can't necessarily take exactly what we say. Does this work? No? Yeah? Okay. My next question for everybody. Does anybody know what happened in 1918? I'm not, obviously not personal, right? Geopolitical. What happened in 1918?
World War.
End of World War I. I put it on here because this, arguably, I'm sure people are going to look at it differently, but 1918 is what started 1031s, but it didn't yet. So 1918, end of World War I, soldiers come home. What happens? What else happened in the tax world in 1918? We had one of the first tax codes, the full tax codes in 1918. Government needed more money because they needed to pay for a war. All these people came home. They were happy we won a war, and so what do? Spend money. And what happens when people get a lot of money and they spend a lot of money? We get inflation going on. What happens when inflation goes up? Central bank said, this is really bad. We need to act really quickly. We need to raise interest rates. What happens after that? Pretty textbook. A lot of things that we have probably, I'm not a politician, but we've probably dodged recently some issues. They look back to these time periods. What happened is in 1920, 1921, and we don't hear about this in the textbooks because what happened later in the 20s, 30s was even bigger. There was a depression. It wasn't a recession, it was a depression. So one of the things, also bad, we have this high, we have this low, and so the government, and I'm oversimplifying this, of course, comes on and has some policies in place. I'm not going to get into all of them because that's not what we're here for, but one of those policies they put in place was a predecessor to the 1031 rules. It's not the same, it was a predecessor to it, but that was in 1921. So we're looking at 100-ish years since this has been in existence. That's a long time. There's a lot of dots on here. There's a lot of dots I did not put on here. The 1031 rules have changed fairly dramatically over those period of times. For now, and I think in recent history, 1031s have always existed and people, rely on them existing, especially in real estate. Who knows what that means for the future? A takeaway on that is a lot of these changes coincide to economic things going on or political things going on. Either the government says, like not after 1918 and 1921, saying we need to spur more reinvestment and sales, and we don't want to hit people with tax. We want them to do this. On the other side of it, though, is sometimes some of these rules were put in place because we need to raise revenue, and so we take some things away. So a lot of the 1031 rules have been policy-driven, not necessarily, trying to spur. There is an aspect of the government says we like real estate and we want people to invest in real estate and we think it's good. There's also, that's the other difference, attorneys are very cynical, but I also look at this as saying that, it's a lot of government either trying to spur something or get a little bit more money. I'm not going to go into all of those dots. I put some of them in there, there are lots more. Let me fast forward to 1979. So between 21 and 79, there were 1031 rules. They weren't always called 1031. There were different tax code sections to get there. But it was a little bit not clear what it meant and how it worked. The only thing that was clear is a direct exchange during this period that said if, real estate owner A and real estate owner B could exchange real estate. End of story. Well, what does that mean? I mean, the only thing that was clear is you hand each other deeds. Beyond that, it wasn't exactly clear. 1979 was the Starker case. Starker case confirmed that the real estate deeds do not need to be simultaneous. So it doesn't have to be a direct, I'm giving Seth a deed, Seth is giving me a deed. There's this aspect of there can be a time frame in between. That case came out in 79. It wasn't until actually later in 84, 86, where a lot of the details started getting fleshed out as to what that means. So a lot of the timelines that were talked about, I think were in 86. In 84 was the first time this qualified intermediary was, I have no idea, I wasn't around doing this at the time. Maybe they were actually using QIs, but it wasn't in the tax code of how that worked. That was in 84. And then the other more modern big change was in 2017. Prior to 17, 1031s were like kind. It wasn't just real estate. Actually, my understanding is the biggest component of 1031s were equipment. It was a lot of fleet equipment, a lot of airplanes, rental cars, where they would sell an entire fleet, buy the next fleet. And they could do that with this deferral mechanism. 2017, we're looking for some money, and we take away, I mean, that's a cynical attorney again, but taking away the right for or the option for the equipment exchanges and leaves it just to real estate. So like kind of a misnomer. Actually, in 1921, sorry, 1921, they actually used the term allow exchange of securities and non-like-kind property, how we get into like-kind, even though like-kind is very broad now because it's just real estate, as long as it's business or investment. That's history lesson, real quick, in a nutshell. So let me talk about the practical, how the flow works for this. I call it documentation, but it's really sort of the flow of the transaction. There's two options. The first, A, is the direct, and we see this very infrequently. I mean, I can think of, I think, one in my career. George Cook from my office is back there. You may have seen a few more direct exchanges than I have, but not many, probably. Direct exchange is back to two people who own real estate, and they decide they want each other's real estate. They're roughly the same value, and we exchange. That's an option. If you do not do that, which 99% do not do that, you need to use a qualified intermediary. Do what we call a delayed exchange or a starker exchange you might hear, where you sell the real estate, you're using a qualified intermediary in between this, and then you buy the replacement property. Let me talk quick about the QI. You have to use, if you're not doing direct, you have to use a qualified intermediary. You cannot touch the money. When you go to that first settlement, that has to go to the qualified intermediary. If you touch it, it is taxable. We had this question actually before the seminar, but arguably there's no undoing it or unwinding it. It's taxable once it's in someone's hands. There's always exceptions where attorneys will help you find an exception, but that one's probably not an easy one. So who is a qualified intermediary? It's not the exchanger, pretty simple. It's not a relative. And this is one, at least as we run into, because we act as attorneys, we act as qualified intermediary. For a 2-year period, on the date of the transfer of the first property, you're not an employee, attorney, accountant, investment banker, real estate broker, or, well, the end there, the last is an exclusion. So if you're working with a regular attorney, you've worked with them in the last 2 years, they cannot act as your qualified intermediary. I will tell you, we do this, and I think most of the law firms in town will do this, where, okay, maybe we're not the qualified intermediary, but we have someone else we work with extremely close, and we still help orchestrate the deal and get it done. It's just on paper, and where the money is going is to someone else as a qualified intermediary to get around this rule. There is an exception for title insurance escrow services. I don't want to bore you with it too much, but we sometimes will use an exception of saying, hey, we just did that last deal as a title agent. We never actually provided legal services. We're not disqualified. Probably more importantly, as you get into that, that's who you can and can't use. Anyone who holds themselves out as a qualified intermediary mostly knows those rules, so that shouldn't trip you up. You don't need to know this. I'm not going to go over details, but this is the extent of regulations on qualified intermediaries. There are about a dozen states, and only 4 of them that require licenses, and they have some requirements that go with them. Pennsylvania is not on there. There are very, very few regulations. There's the IRS regulations of who qualified and how they do it, but actually regulating how they do it, things like making sure they have E&O policy or separate escrow accounts or any type of licensing, it is very, very sparse. And so most of the QIs you work with are not really regulated. You're regulated from the IRS perspective of knowing what to do and helping you, but they're not regulated. And there's a lot of money that goes from, again, you can't touch the money, you can't control the money, it goes to the QI's account. And then the QI holds it on your behalf. You have a contract that says you have the right to it. but you better trust your QI, is my point. There is a case, I think I have a, do I have a slide for this? Yes, I do. No. Sorry, thought I had a slide for it. There is a case from 2008. Another history lesson, what happened in 2008? I think we all know that. We also had that big downturn. There was a company called Land America 1031 Exchange Services. This is the big noted one. There's others out there, but this is the big one that kind of shook up the industry. Before '08, what was going on was there was a lot of really good investments going on out there. There are QIs out there who, there's different models. Some QIs will take the money in, put it in an account. These days, everyone demands for it to be an interest bearing. Sometimes it is, sometimes it isn't, but most exchangers want that in an interest bearing account while they're holding it. I don't know if there's current as many doing this, but there used to be prior to this, a lot of QIs, especially the big national ones, who, they'll pay you interest, but they're going to keep a percentage of the interest for themselves. And that's, again, it's not regulated. They have the ability to do it as long as it's disclosed somewhere. You're aware of it. It's how they make their money for a low exchange fee up front, is they get a percentage of that interest during the period they're holding it. That alone, it's a cost benefit analysis. But back from 2008, we had Lehman Brothers crash. Land America had been putting all its QI proceeds, I want to make sure I get the terminology right, into auction rate securities because they had a good return on them. And they were had good returns for their exchangers, and they were taking some of it themselves. And what happened was, with the crash, everything came to a halt. The exchangers have these tight timelines of 45 days and 180 days. They have settlements coming up. Can't get the money. It's stuck. Land America filed bankruptcy. I don't know I think, I didn't follow it that close. I think of the exchangers eventually got their money back after this stuff was liquidated. I don't know if they took haircuts or not, but they had to file bankruptcy with all that money in there. There was some special relief from the IRS under these circumstances, these limited circumstances, to allow for the stretch of some of those dates because of everything going on in the US at that point. There was some leniency, but back to know your qualified intermediary and what you're getting into. So back to documentation on this. You must have an exchange agreement. Sounds fairly simple, but keep in mind, you have to have an exchange agreement at or before you go to settlement when you sell your relinquished property. So you can't say, and we get these calls, you get a call from a client saying, hey, I'm really interested in 1031, can you tell me about it? And then partway through the call, they say, yeah, we closed last week. How does this work? And you have to have that uncomfortable situation because we want to help people. We want to try to find a way. There's no way out of that. Other than selling it back, maybe, if that even works, and buy it again. There's no way out of that. You're stuck. So you got to have that exchange agreement. Part of the documentation requirements, just walking through those real quick. There's a little bit more than this, but the ID notice that we talked about, I'll talk about that a little bit more. Settlement sheet needs to be set up appropriately. We usually recommend, if you're doing one of these, get your QI lined up before closing, obviously. Give them a chance to get the exchange packet together. The way we handle it, a lot of QIs will handle it, is saying, give us contact for the title company doing the closing, and we then help set these up. Most title companies in the area know how to do it, but they do need to be talked through, how we want this one set up. Certain 1099 requirements, and then there's a form 8824, I think that's still the same form number. So this is the just general book of, the start of what our exchange agreement looks like. There's a lot of stuff that goes in here. A lot of these are technical documents we should have. There's a fiction of, at closing, you are giving the right to sell this property to the QI sells the property, QI gets the money, then you're assigning the right to buy the next property to the QI, and they kind of buy it, and then they give you a limited right back to take title to it. So it's a lot of tax fiction, really, to say the QI is in the middle, but this is what we do to put this together. At the end of an exchange, most QIs will come back to you with a book, a book with all these documents. Give those to your accountants to make sure they can easily put the return together. The next one I wanted to talk about on there, the settlement sheet. Talk briefly about what can and can't be part of this. Sometimes, depending on the situation, we say, maybe that you have a rental property. On that rental property, you have security deposits. You can subtract ordinary cost of settlement, but giving the security deposits to the buyer is not an ordinary cost of settlement. So most of the time, we would say, okay, there's a reconciliation for that, but handle it outside of the settlement sheet and write a separate check. Probably the cleanest way to handle it. There are ways of doing it here, and then with the exchanger actually putting money in, and then you have to identify. I personally don't prefer it that way, but other ways you can handle that. A lot of what we're trying to get to is down here, be as close as possible to a zero. Unfortunately, you sell a real estate, you get nothing. That's not fun, but that's the game to make the 1031 work. And you can see, the money actually goes out. Do we have this set up? Oh, right here. Proceeds to the qualified intermediary. So the money comes out at settlement directly to that QI. ID notice. There are 3 ID rules, and these are important. That 45-day window is a drop-dead date. This is not a date we can fudge or play with. People have gotten into a lot of trouble playing with dates with 1031s. I believe someone's gone to jail over that, at least one or more. There's three roles. One is you can identify 3 properties, and this is in 45 days. We're selling a big property. It's hard to find your replacement property in 45 days. So we always tell people as soon as we're involved, make sure you're looking now for what your replacement property is, especially if you're looking for commercial real estate. 45 days comes and goes very quickly. And this is a hard deadline. You can identify 3 properties, buy any one or multiple of those as part of the exchange. That ID notice, our request is you sign it, you give it to us as the QI, we acknowledge it within that 45-day window. You have to have some way of transmitting that information. There's also the 200% rule. We run into this at times. So if you are selling a big property and you decide, I want to buy, this happens at times, I want to buy these townhomes, but I'm going to have to buy more than 3, you can identify as many as you want as long as the total value of all the replacement properties does not exceed 200% of what you're selling. So if I sell for $100,000, I can identify up to $200,000 worth of properties under this rule and put as many as I want on there. And that's probably where we use that rule the most, is someone selling a property and buying townhomes. The third rule, the 95% rule, does not get used often. This was actually used a lot more when you could do equipment exchanges when you're selling a fleet. You can identify as many replacement properties as you want, any value you want, but you have to purchase 95% of them, 95% of that value. So obviously you're not going to identify millions and millions and millions of dollars of real estate if you sold a $500,000 piece of real estate, because now you're going to have to actually buy all of them if that's the rule we're using. So that does not get used very often at all. It's there and can be used, but not as often. Again, on the big issue, keep in mind on this is that's in that 45 days. You've got to have this in the 45 days. The way we look at this is, if you're within the 45 days, things happen on an agreement. You're under agreement, you put 3 down. You don't have to be under agreement to buy them, but you have to list them. And you decide, well, this one isn't going to work. So I want to replace it with another one on my list. If you're within your 45 days, you can re-identify. We can say, okay, that identification is gone. We are going to substitute with a new identification as long as you're within your 45 days. Once you hit your 45 days, you are stuck with these. There's exceptions to the rule, but they're very limited. You have to buy one of those properties or your exchange is stuck. And I say stuck because if you decide to not move forward because these properties just don't make sense for you anymore, the QIs cannot give your money back until the end of the 180 days. So you're kind of in limbo. It's still your money, you'll get it back, but it will take some time to do that. There's some exceptions that if the properties cannot be purchased, that we can deal with and get the money back earlier. You can't substitute, but maybe we could end the exchange earlier. Things like the property's burned down and it's impossible to buy. Someone else bought it and therefore it's off the market. Those kind of things will sometimes give us room. There can be some gray area, so we got to talk. But I usually advise people up front, just understand you very well might get stuck with this exchange if you don't follow through.
You usually recommend that people buy or identify multiple properties because of that, or?
Oh, yes, yeah. I usually try to push people, even if they're saying, no, I want this property, I want this property, then you might want to look around just in case. Things happen. Because if you didn't close within the 45 days, who knows? You might, and keep in mind, you have a lot more riding than just you purchase or don't purchase. It's also, if you don't purchase, now you have this big tax hit, kind of puts you in a disadvantage in negotiations if your seller knows that. I would rather multiple properties if we can. $8824, I'm not going to get into that. We don't file that. That's in the accountant's realm. This gets filed with your tax return. So with your tax return, they have to notify it is a 1031 exchange. The only thing I will point out, and we're not, with time, we can't cover everything, and I probably went way over my time already, sorry. Related party exchange. And if you ever have a related party exchange, we can talk about it. In theory, you can do them. There's a ton of risk with a related party exchange. And worst of all, they get flagged up front. Doesn't mean you can't do them. Sorry, I think I am going over my time here. One last thing I want to cover real quick, which I think is a opportunity that I've seen clients use a tremendous amount more recently, is the use of disregarded single member LLCs. So the general rule is with a 1031 exchange, when you sell one property, you have to buy the new property in that name. The only exception to that is a single member LLC. From a tax perspective, from an IRS perspective, it does not exist. So you can sell it, sell one property. Dustin sells this property, and he buys the next property in XYZ LLC. It works, assuming that it is single member and disregarded. It works. Then there's a whole planning thing you can do later. I don't want to get into all the intent issues and other problems it could raise, but let's just say down the road, years down the road, if you wanted to get kids to have ownership or spouses, you have the entity already set up, and there's things that you can do that make it really nice, not to mention just the liability protection. Not everyone's aware of this. I don't know if some of the online providers are doing that or not. I know we do it. It is allowed. There's private letter rulings. Keep in mind they're private letter rulings. Private letter ruling means IRS has addressed this issue for a taxpayer and said, taxpayer, you can do it. Doesn't mean it's in the tax code. Doesn't mean they can't take another position later. Unlikely they will, though. Very unlikely. Sorry, I probably went over, but Randall?
Good.
I don't know if there's any questions, or are we saving questions for the end?
What was the phrase that you used when the IRS addressed this use for the issue for the taxpayer?
I'm sorry?
Private letter rule.
Private letter ruling, yeah.
Thank you.
They're quite expensive.
Yeah, no, I don't think we're gonna get one.
$50,000. So Dustin touched a little bit on intent with, well, be it a flipper, be it a property or a land developer, like what is your intent? And there's a lot of court cases. It's very much facts, circumstances. What do you have paperwork wise to prove what your intent was? Pretty hard, probably. So intent is very important. I always like to take a step back when I'm thinking about just planning for my clients. And so the next thing is like, hey, what's your end goal? What are we trying to do? I've had in my almost 20 years of doing this, I've seen a couple of people where they have done a 1031 and then a few years later, that property, that replacement property, they sell. And it's like, well, that wasn't good planning. Like, this should be a long-term strategy. If you're doing a 1031, in my mind anyway, you should be thinking, this should be going to my estate, you know, this should be going to my heirs. This, right now anyway, as the tax code stands, you get a step up in basis. They tried to do away with that. I think it was now 2 falls ago, but it did not pass, thank goodness. So there will still be a step up in basis. It just happened recently. One of my clients, father passed away, his 2 sons got the real estate and the business, and the real estate had an extremely low basis, and they immediately turned around and they were in the middle of selling the company anyway, coincidentally, turned around and sold it for almost no gain. And, you know, the difference was, you know, millions of dollars for them. So huge deal. So don't like think, oh, I'm going to save, I'm going to defer. But then in a few years you need the cash, because you got to realize you are giving up the cash. And sometimes cash is good to have in hand, which means then you're paying taxes. I think Seth is going to talk about partnerships a little bit, so I don't need to beat a dead horse on that, but just to say partnerships are complicated. If one partner doesn't want to do it, another partner wants to do the 1031, you kind of have to do some additional planning because of that. So what are we deferring? As Dustin talked about this, you got your depreciation gain, that's taxed separately, shown separately. You have your capital gain. You have net investment income if you're not a real estate professional that you will be paying, and then you have your state income tax with, I left blank, but in Pennsylvania it's flat. It's 3.07%. So that's what we're deferring. Just a simple side-by-side example where you can see at the end of the day, what are we trying to do? I have a lot of real estate investors as clients, and one of them just preaching, well, he was preaching to his partner, because it was in a partnership, and they were trying to decide whether to do a 1031 or not. And the client I represent was saying, no, I don't think this is worth it. It's not going to take us to the next level. The whole point, in his mind, the whole point of a 1031 is, hey, we started in a single family home, and, you know, because of appreciation, because we held it for a few years, now it's worth maybe double, and we can turn around and we can buy a duplex or, you know, a triplex or something. In his mind, that's what you do. That's why you do a 1031. You're not doing it just to save taxes. But you could see, you even though you're not getting the cash, you do have a lot more to invest in your next property if you do the 1031. So I'm going to skip this one, just kind of saying the same, you know, here are our options. And since Dustin mentioned vacation home, so there are some basic rules with this that you do need to be aware of. It's really not that hard to meet it. Basically, I guess it says the safe harbor there. It's got to be owned at least 2 years and rented for more than 14 days. But then there's also a personal use component. So I know sometimes I struggle with getting personal use out of my clients. How much were you at your beach house? Probably should put some personal use down. If you put 0, that's kind of a red flag. I think one of my relationships, they do syndications, and it's funny. Maybe she doesn't know how much time she spends in all of her different like vacation homes, and maybe she has that many, but she's like, use 10 days. So that's what she uses all the time. I think the other part to watch though is the actual rule is 14 days or 10% of the time rented. So if you wanted to qualify and you only rented a very small amount, you're gonna get caught up with that. Aaron mentioned this with the farm question, that there can be two things at play. You can use code section 121 or the homeowner's exclusion, which most of us in here probably are familiar with. If you're married, 500,000 hasn't been inflation adjusted for a long time. Probably something we should ask to be added to tax law changes. 250,000 if you're single. But you can have situations where you can have both, whether that is the farm example where you want to 1031 the land and then use a homeowner's exclusion on the actual residence. But you can also have a situation, I mean, in the last 5 years, Airbnbs have become so popular. People are Airbnb, out their basement, they have something over their garage. They're doing Airbnb with. Well, you can't use your homeowner's exclusion on that. So now you're in a situation where you may want to use both code sections. So obviously it's more complicated. Home office use is a lot more popular. I mean, depending on the size of the office, I mean, technically you can't use the 121 exclusion on that. So is it worth doing a 1031 on a home office? Probably not, but I know I heard a presenter talking, and he must have worked from home for a while, but anyway, the value of his home office was 1/3 of his house, and his house was in California and worth like $2 million. So he was talking about he was in the middle of selling it, and he was using both. He was doing a 1031 and using his 500,000 on his house. So you can do that. Obviously, it could be the other situation there where you have 4 units and you decide to live in 1 unit. You can also convert a residence. You can go, it can become a rental, or you could be converting a rental into a residence. Probably don't want to change your CPA through all of that. There's a lot of mind-numbing basis schedules to keep track of. The installment sale. So I ran into this a couple times. Because of the 45, 180-day rule, if you happen to, if your 45-day runs into the new year, let's say you do a 1031, you sell the property before the end of 2024, the 45 days goes into 2025, 180 days obviously would be in 2025. Usually how the contract is written, assuming even the online vendors can get the language right, I haven't vetted every contract. Your contract usually states like when the funds are available to you, and because the funds aren't actually available to you, even if you know you're going to partially fail, you can actually still do the installment method and defer. So we had a client here this past year that had a pretty large 1031, but they also had a pretty large fail 1031, like the same transaction, because they just couldn't identify enough. And so they were getting ready to stroke a check, and I got pulled in to look at it, and I was like, wait a second, you could defer this. You could be in a different tax bracket next year. It could actually go from 20% to 15%. You could potentially save NII. We did some, quick math, and obviously time value of money. They didn't have to stroke the check, but the delta between where they thought they were going to be next year was going to save them probably $50,000 to $70,000. So it was worth it. It was worth us investigating that, because that actually wasn't a deferral, that was permanent savings because of paying it in 2024. So that's what this example is looking at. My last couple slides just are on a couple other options that you have. I haven't had a lot of clients do this. A lot like to kind of control what their replacement property is, but if you are someone that, you know, you're tired of managing the property and you just want to have a passive investment, these DSTs are really good. Now, the DSTs aren't going to be an awesome return on investment. Think the corner CVS store. That's what a DST is investing in. They're investing in something really safe, really predictable. And I think a DST can have like 499 investors in it, or, unless I'm confusing it with the next slide. A lot of investors can be in it. If I can move this without it moving the slide. No, that moved the slide, did it? I have my notes here.
Go scroll.
I know, I tried. How do I scroll without?
Use the mouse and click on the bar
Oh, here's the mouse.
or the
It's not plugged in. Come
pad.
on.
The pad on the.
Not super important how many investors, but basically you identify it in the 45-day, the DST you identify, and you say, hey, and you can even look at what they're offering. They're always offering properties, so you would know where it is. It's probably not in Pennsylvania, it could be somewhere else. And then you sign up for it, and I think a lot of times it has a lifespan. It's not like it's going to be permanent. And I have not run into these. Very often. I have had one client, I think, invest in a 721 exchange, and it's the up is umbrella. It's an umbrella REIT. Basically, that's even more passive. You actually get a dividend, so it's basically like you're investing in the stock market, and you can actually. I don't know if the UPREIT can deny you, but you can actually exchange your property to them in some situations, which is really weird. But so this is an interesting opportunity that is out there. Last one, Seth, because I want to hear your stories.
All right.
Qualified Opportunity Zone Fund. We haven't had a lot of clients that have invested in them, partly because we're not in New York City. I mean, New York City was pretty hot for Opportunity Zone funds. There wasn't, Columbia, the city of Columbia actually had an area that was designated Qualified Opportunity Zone. Lancaster City, I think, had a section as well. But there can be opportunities to think, hey, would Qualified Opportunity Zone actually make more sense at a 1031? And really the quick analysis would be, and I'm not going to get into what they are due to time, but basically if you have low debt and high basis, meaning you're going to end up having a low gain, the Qualified Opportunity Zone would be better because you only have to put in your capital gain into the fund, so you would actually be able to keep more cash. And then a situation where you'd have high debt and low basis, that would be definitely a 1031. Thank you.
All right, I think I have 15 minutes or so. I will go, I'm going to talk a little bit about our most common phone calls, at least that I field at the office, with regard to 1031 exchanges. They're reverse exchanges, construction exchanges, also known as improvement exchanges, and partnership issues, which was touched on a little bit earlier. So just a basic breakdown. In your normal situation, in a delayed or a forward exchange, which we always encourage, that's the cleanest, easiest, most liability-free way is to do the forward exchange. And we'll bend over backwards to help you do a forward exchange. But there are situations when that doesn't work. And what you have to do with the reverse exchange, it is an option that's sometimes appropriate, where you have the replacement property needs to be purchased first. But you can't control it, because the rule is you can't control both the relinquished and the replacement property at the same time. So you have to find a way to buy that property first, and then complete the sale of your relinquished property within the 180-day window. This poses a problem because you need to park that property in what's called an EAT, an exchange accommodation title holder, which is a third party, an unrelated third party who needs to hold that property for you until you can get your property sold and apply the funds to it. And as you can imagine, there's more cost and potential problems with identifying an appropriate EAT and then moving the property to the EAT for that period of time. And essentially what you're doing is you're creating two closing transactions here, which often incur double transfer tax. And often lenders are a little more hesitant to finance this situation. So if you're an entity or a person who has a lot of cash laying around and can just buy your replacement property outright, great. This type of thing might actually work out pretty well for you. But if you have to get financing involved and to make that initial purchase, maybe you can do it. We have a lot of willing lenders who are willing to explore that with you, but it's not something that can often be done in a quick turnaround time. And back to that phone call, the phone call I get is, Seth, I was at an auction over the weekend. I bid on a property. I didn't think I'd get it, but I did. It's a great property, but I have to close in 60 days. I need to sell my apartment building to fund this thing. Can we do a reverse? And the answer there is almost always no. Not in that scenario, but unfortunately a common phone call. So the reverse exchange, we get a lot of questions about the reverse exchange. I just want you to know that it exists. And it is an option for you, but as has been repeated many times up here, it requires planning and foresight and conversations with your accountant in advance in order to do it. It's not a great option when you're in a hurry. You can get stuck trying to sell your property for a bad price and many other issues that can come up related to that. The next slide should be, nope, wrong way. Improvement exchanges. Get a lot of calls about another type of parking arrangement. Again, this is when you're putting the property in an EAT, an exchange accommodation title holder, that third party that's going to actually hold title to the property for you. Construction exchanges are possible. I don't get involved in them a lot, but I get a lot of questions about them. So the basics of it are you can do this in a forward exchange or a reverse exchange, but we'll stick with the forward exchange here. You enter into a contract to sell a property that you own, and you want to use those proceeds to buy another property. You sell your property, the funds go into a QI account, holding that money for you. You identify in that 45 days a replacement property, but maybe the property is in disrepair, maybe it's not exactly what you need, maybe you need to increase that value to make your exchange worthwhile. And so you decide, okay, I like that property, love the location, but I got to build something better there. You can enter into an arrangement where the EAT holds that property while it's improved, increasing the value of that property, and then ultimately buying that property back from the EAT once you, with your 1031 money. And of course, your 1031 money can be used for the improvements. A couple of big problems, though, with construction improvement exchanges, also called built-to-suit exchanges sometimes, are the 180-day period. IRS code has not kept up with subdivision land development ordinances, HOP permits, NPDS permits. You're never going to get something from start to finish in 180 days. So right off its face, 90% of the phone calls about this end before they get started, because there's no construction plan, and there's usually the time is starting because there's an agreement that's been in place already, or the property is on the market and they got to get moving. So again, there's limited circumstances in which it can be done, but I just want you to know that it is a possibility. Okay, this is the dreaded TIC, tenant in common ownership. It was mentioned that many properties, if not the majority these days, are held in LLCs. Many partnerships are still out there, and partnerships break up, and LLC members decide to go their separate ways after holding a property together very often. You can't exchange partnership interests, so if you hold a property, let's say you and your two brothers own a property together, it's appreciated in value, at least two of the three of you want to sell and move on, but you don't want to reinvest together. It does put you in a bit of a bind because you can't exchange your partnership interest, and you don't want to invest together. So now you're stuck where you have to sell the property and pay the tax unless there's another way. And that other way is often called a drop and swap. So the events of a drop and swap I have here, there are realty transfer tax issues and other things that can come up here, which I won't get into now. But ultimately, you can drop the property and out of the partnership into the individual names. And when I say partnership, I also mean an LLC. It could be a corporation as well. You can drop the property down to the owners in proportion to their ownership interest. Now you have a situation where the individuals own the real estate as tenants in common. Why I have the much feared insect on the board is that tenant in common ownership is never, very rare that we would ever recommend to own property as a tenant in common. Tenant in common has a lot of issues. It has liability issues. When you own a property as individuals together as tenants in common, any liability of your partners can come back to haunt you if they have debts or other financial problems that could maybe even interfere in the sale of the property. If one of them dies, now guess what? Whoever they listed in their will is now your fellow owner of the real estate, and it's very often not someone you ever wanted to own real estate with. And there's many other problems with the TIC. So there is something called a TIC agreement that we can mitigate a lot of these risks with, but again, as the theme, always with proper planning ahead of time. So in the drop and swap, we drop down to the existing partners, and then they are free to, once the property is sold, to allocate their money to a 1031 exchange, each of the individuals, and move on their separate ways and do their individual 1031 exchanges. The story about the TIC that resonates with many of my clients are we all know people, and maybe you do, let's say the three brothers who buy a piece of land together, they're thick as thieves, they love each other. They buy a piece of land up in Potter County and they build a cabin on it and they go hunting up there every fall together, and this goes on for decades and it's wonderful. But over time, they all have children and families of their own. And the garden variety title company up in Potter County who did the deed for them just put all their names on the deed when they bought it, so now the three of them own it. And now, there's nephews running around up there, and the second generation gets along, but maybe not as good as the three brothers. And then before you know it, your nephew has a couple of kids of his own he's bringing around. And ultimately, by the time you get to the third generation in this situation, it's very rare that things are as friendly as the original three brothers. But you're stuck with it. If you don't have a TIC agreement, you're stuck with that arrangement. It can be very costly to unwind that situation. And inevitably, one of the brothers dies. You're now an owner. The other brothers are owners with their nephews and nieces, and even in certain situations, various cousins of theirs that they didn't even really know existed. And again, that's sort of the horror story about the TIC, keeping in with the woods theme there. Not our recommended form of ownership. And in this situation, one of the risks is you are dropping it down for a period of time until that property is sold, and you have all of those potential issues with tenant in common ownership. But it can be done. And my goal here is just to impress upon you those three major questions that we get, or at least that I do. Can I do a reverse exchange? Can I do a construction exchange or an improvement exchange? And hey, what about this drop and swap business? Can I do it? And what are the risks? I have a couple more minutes, and then we'll do Q&A, or do you want to hop right into Q&A? I have, or Or are we trying to leave time?
I would say, is there a lot of questions? The two thoughts are we do Q&A live like this, or we could start the happy hour and do Q&A during happy hour, which might lead to better answers. I don't know.
All right, I'll tell one more story before we go. It's a good, I think, wrap-up story. It's a true story, and it's a good segue because I don't do 1031s without consulting with the exchanger's accountant. It's a rule of mine. I don't think Blakinger Thomas has a written rule about it, but I've never done an exchange without having a consult with the accountant. And a perfect example of that is I got a call from a client. He had a multi-million-dollar property he wanted to sell. He had identified already properties that he was very sure he could get under agreement, and he was going to get hit with hundreds of thousands of dollars of tax because this property was a real winner. It had appreciated greatly. So after talking it through with him, this was just an obvious win. Let's do it. It's a forward exchange. Everything's going to be lined up nicely. So I called his accountant essentially to tell him what we were going to do, and the accountant slammed the brakes on, said, no. What you don't understand is that the client had other sales earlier in the year that are going to result in a lot of tax liability next spring, and he doesn't have the liquidity to pay that tax bill if you invest all of his money into another property. I said, okay, and he said, also, he has high interest debts that he can service, but really would be better long-term for him to pay that high interest debt down with this cash, because in the long run, the math can get quite complicated, but it was going to be a much bigger win for him in the long run to take that cash, take the liquid cash and actually handle his affairs, make sure he had enough to pay his taxes in the spring. Otherwise, he would have been running from the jaws of the lion straight into the jaws of the wolf, desperately trying to avoid this horrible tax, but then running into even bigger tax problems in the next tax year. So thank goodness I made that call because what appears a clear win isn't always the case, and we shouldn't think that 1031 is always the solution, even though it is a very powerful tool. So good segue to always make sure the accountant's involved.
Does anybody have any questions that they're desperately hoping to ask with the whole group here? If there's nothing real specific, we can head out and enjoy some refreshments and hang out in here or out here.